usually when you walk down the produce aisle, right, you put a tomato in your cart, and there's this like expectation of simplicity.
Yeah, it's a very comforting illusion. We like things to feel linear.
Exactly. You imagine the farm, you see the truck, and you interact with the supermarket. It all feels so straightforward.
But we are completely insulated from the actual mechanics, the chemical and geopolitical realities that actually put that tomato on the shelf.
Oh, 100%.
Yeah.
And the second you step into the real mechanics of global agriculture, that simple picture just totally shatters. You are suddenly looking at a supply chain landscape that is almost entirely invisible to the consumer.
Right, because most people aren't tracking industrial chemistry on their grocery run.
No, of course not. I mean, you don't usually think about like molten sulfur logistics in the Middle East when you are buying a box of cereal to feed your kids.
But after today's deep dive, you absolutely will.
You really will. So welcome to the deep dive, everyone. Our mission today is to break down the Q1 2026 earnings call from the Mosaic company.
Yeah.
And honestly, the data inside this transcript is flashing bright red warning signs.
Red warning signs for global food security, specifically. And for anyone who might be new to them, Mosaic is one of the absolute largest producers of phosphate and potash crop nutrients on the planet.
Yeah, they are a massive player. And we aren't looking at this just to, parse a corporate balance sheet.
Exactly. Their earnings calls are vital because they operate as the canary in the coal mine for the global macroeconomic system.
Right. The data they release, their raw material costs, their production volumes, it tells us exactly what the broader economy will be experiencing at the grocery checkout line.
And right now, what it's telling us is that global agriculture is operating under severe multi-continental strain.
Okay, let's unpack this, because the core tension driving this entire Q1 report absolutely blew my mind.
It is definitely a paradox.
It really is. Mosaic is this massive industrial company that produces the exact chemical compounds the world desperately needs to grow food. Right? Demand for calories is not going down.
No, people still need to eat.
Right. Yet right now, they are actively choosing to halt production of that essential fertilizer. They are purposely shutting down millions of tons of production capacity.
What's fascinating here is that we are watching real-time demand destruction. But, and this is key, it is not driven by a lack of end-user appetite.
So it's not that farmers don't want the fertilizer.
Exactly. It is entirely dictated by raw material bottlenecks on the complete opposite side of the planet. We are looking at a collision of chemical realities and geopolitical conflict.
It is a masterclass in how global macroeconomics actually functions. The overarching theme of their presentation is extreme volatility.
And that volatility is driven directly by what is happening right now in the Persian Gulf and the Black Sea.
Yeah, the executive team was incredibly blunt about this on the call. We're not talking about standard, cyclical shipping delays.
Far from it. The ongoing conflict in the Persian Gulf, layered right on top of the protracted war in Ukraine, has severely fractured the global phosphate supply chain.
And to understand the scale of that fracture, you really have to look at the concentration of raw materials in that specific region of the Middle East. I pulled the specific data points management highlighted, and the concentration risk is just staggering.
Go ahead and lay out the numbers because they are really the anchor for this whole situation.
Okay, so roughly 20% of the world's global phosphate originates in the Middle East.
Right.
A third, so 33% of all urea, 25% of the ammonia, and here's the real kicker. A staggering 50% of the world's seaborne sulfur volumes come right out of that region.
50%. When you take half of the world's seaborne sulfur and trap it behind a geopolitical conflict zone, the math breaks down.
Completely.
And then you add in the millions of tons of product locked up in the Black Sea. The CEO explicitly noted that nearly half of all phosphate raw materials globally are currently impacted by these combined conflicts.
And it's not just the Middle East and Eastern Europe either. China has essentially slammed the door shut on the other side of the world.
Yeah, Beijing has banned phosphate exports completely through August to protect their own domestic agriculture.
So you have half of the raw materials caught in a war zone, and one of the largest producers just pulling its supply from the export market completely.
To really grasp why a disruption in sulfur specifically grinds a phosphate company like Mosaic to a halt, we have to look at the chemistry.
Right, let's get into the chemistry of it because it's not as simple as just digging up some dirt.
No, not at all. You cannot just dig phosphate rock out of a mine in Florida, crush it up, and throw it on a cornfield. The phosphorus in that raw rock is largely insoluble.
Meaning the plants literally can't absorb it.
Exactly. To make usable concentrated fertilizer, You desperately need to bathe that rock in sulfuric acid.
And sulfur isn't something you just, mine on its own anymore, is it?
No, it's largely a byproduct of oil refining. It comes from the desulfurization of crude oil and natural gas.
Oh, wow. So if oil refineries in the Arab Gulf are damaged or even just threatened,
Or if the shipping lanes, like the Strait of Hormuz, are restricted because commercial vessels are being fired upon, that molten sulfur simply doesn't move.
and if the sulfur doesn't move, you cannot produce phosphoric acid.
Precisely. The entire system locks up.
It was basically like trying to bake a massive wedding cake, right? You have the sugar, you have the butter, your industrial ovens are fired up.
I like this analogy.
Thanks. But 50% of the world's flour is suddenly locked behind a military barricade. It absolutely doesn't matter how badly people want that cake.
Or how much money they're willing to pay for it, yeah.
Exactly. Without that base ingredient, the system freezes. You just cannot bake.
And that chemical bottleneck translates directly into a massive financial bottleneck. This dynamic completely dominated the Q&A session with Wall Street analysts.
I really want to dig into this part because when I first read the transcript, the PR spin from Mosaic confused me a bit.
How so?
Well, they spent a lot of time explicitly highlighting their massive structural advantages. They pointed out that they get 80% of their U.S. ammonia needs from their own local plant in Louisiana.
Right, or from domestic contracts tied to cheap natural gas.
Yeah. And they get 80% of their U.S. sulfur straight from Gulf Coast oil refineries via a dedicated molten sulfur supply chain.
So they have all these ironclad local long-term contracts.
Right. So if they have all that local supply locked in, why are they panicking over spot prices in the Middle East? It seemed contradictory.
I get why that's confusing. The CFO, Luciano, had to carefully walk the analysts through this exact dynamic. The key is understanding the difference between average cost and marginal cost.
Okay, translate that Wall Street jargon for us. What does that actually mean for their operations?
Sure. Average cost is a backward-looking metric, while marginal cost dictates your forward-looking decisions. Because of that dedicated Gulf supply chain and older inventory, Mosaic's average cost of sulfur in Q1 was $379 per ton.
Which sounds totally manageable, right? $379 a ton allows them to turn a pretty healthy profit.
It does. But average cost doesn't help you produce the next unit of fertilizer once your cheap inventory starts running low.
Oh, I see where this is going.
Let's apply this to your cake analogy. You have enough cheap flour in your pantry to bake 80 cakes, but the market is demanding 100 cakes.
So to bake those last 20 cakes, you have to go out into the open market today and buy incremental flour.
Exactly. That is the marginal cost, the price to buy the very next available ton on the open spot market. And because half the world's seaborne sulfur is trapped, the global fertilizer industry is fighting over a tiny pool of available supply.
And that fight has pushed the price for that next ton, the marginal ton, to a staggering $1,200.
It's incredible.
We were talking about a jump from an average of $379 up to $1,200 just to keep machines running at maximum capacity.
And ammonia is experiencing a parallel shock, hitting around $800 per ton on the margin. When management models out their production for the second quarter, they have to use that $1,200 sulfur figure.
Which creates a completely bizarre economic paradox, and it leads directly to the massive operational decisions they announced.
The curtailments.
Yeah, Mosaic is temporarily curtailing production. They are explicitly reducing production rates at their Bartow and Louisiana facilities by about half of their total capacity.
And those are not small facilities.
Not at all. Bartow is a massive operation with 2 million tons of capacity. Louisiana has 1.4 million tons. And they're also scaling back their fertilizer production in Brazil.
The underlying math leaves them absolutely no other option. If we look at their pricing guidance for the second quarter, they project the selling price for DAP diammonium phosphate. The standard benchmark will sit between $760 and $780 per ton.
Okay, wait. So we are looking at their stripping margins, and the numbers are completely inverted.
Yeah.
Just to be clear for everyone, stripping margin is basically the profit left over after you strip away the cost of raw materials from the final selling price.
Right. And if the final product sells for $780, but acquiring the marginal sulfur and ammonia to produce it costs way more than that, your profit is gone.
It's literally vaporizing. They are looking at a negative stripping margin on the spot market.
They would literally be destroying shareholder value by operating at 100% capacity. In the first quarter, backed by that $379 sulfur, they enjoyed stripping margins near $400 per ton.
And now The marginal stripping margin has fallen below their variable costs. It makes zero sense to run the machines.
None at all.
Now, I was looking at these product mixes in the report, and I'm trying to understand why a shift in what farmers are buying is exacerbating this specific problem.
Product mix is huge here.
Management noted that customers are demanding more MAP monoammonium phosphate. If it's all just base fertilizer, why does the specific chemical mix matter so much to Mosaic's bottom line right now?
It comes down to the volume of raw materials consumed per ton of finished product. MAP is highly concentrated. It's composed of about 52% phosphoric acid.
Okay.
Conversely, Mosaic has a premium product line called Micro Essentials, which only requires between 33 to 40% phosphoric acid.
Ah, I see. So when the market shifts heavily toward MAP, unit costs inherently skyrocket.
Exactly, because you are forced to consume significantly more of that incredibly expensive $1,200 sulfur to produce the exact same metric ton of final product.
The CFO noted this dynamic will fade when their product mix normalizes, but in the immediate term, it just acts as a massive cost multiplier.
It really does.
So what does this all mean? It means a Mosaic is making a highly disciplined financial choice to preserve cash rather than chase unprofitable volume.
Which Wall Street generally loves.
Sure, but management kept stressing these curtailments are temporary. They framed it as a brief pause, waiting for conditions to improve.
And you aren't buying that.
I have to push back on that narrative. If we look at the realities of the Persian Gulf and the Black Sea, these aren't conflicts known for rapid, neat resolutions.
That's a very fair point.
At what point does Wall Street stop buying the temporary label and start viewing this as a permanent destruction of their production capacity?
That is the exact tension driving the skepticism from some of the analysts on the call. The word temporary implies a rapid reversion to the mean.
Right? Like things will just go back to normal next month.
But a structural shift in global trade routes, driven by militarized choke points, doesn't just revert quickly. If this conflict extends beyond Labor Day and deep into the winter, Mosaic's temporary curtailment becomes a heavily entrenched reduction in global fertilizer output.
And the global hunger for fertilizer hasn't magically disappeared just because Mosaic turned off a machine in Louisiana. People still need to eat.
The demand is absolutely still there.
Yeah, but this massive supply shock is revealing a bizarre geographic divide in how different countries are handling the crisis. Demand is violently splitting based on regional economics and government policy.
It really is a fascinating global tug of war. If we start in the United States, the farm economics are currently operating under a very tight margin environment.
Because interest rates are so high, right?
Yes, high interest rates make financing expensive. Plus, agricultural commodity prices, the actual payout the farmer receives for a bushel of corn or soybeans, have been under intense pressure.
Right. The U.S. farmer is operating in a largely free market system. They look at the high cost of fertilizer, they look at the lower price of corn, and they are making the calculated decision to just delay their spring purchases.
The math simply doesn't justify the investment for them right now.
We see a similar but far more severe dynamic playing out in Brazil, don't we?
We do. The Brazilian agricultural sector is facing a profound credit crunch. Their benchmark interest rate, the Selic rate, has been elevated, which dramatically tightens the availability of financing.
And Brazilian farmers heavily rely on credit and barter systems to secure their inputs before the harvest, right?
Exactly. And because capital is so expensive and scarce right now, the in-country inventory of nutrients in Brazil has plummeted to dangerously low levels.
Some of the metrics they shared were wild. We were looking at certain fertilizer inventories down 50% year over year.
It's a precarious situation. Brazil relies on imports for roughly 85% of their NPK, nitrogen, phosphorus, and potassium needs, and they simply lack the liquidity to bring that supply into the country at these elevated prices.
But then you look across the globe at Asia, and it is a completely different universe.
It's night and day.
In India, the government views fertilizer purely through the lens of national security. They were stepping in and heavily subsidizing imports, effectively shielding their domestic farmers from these massive global price shocks.
Right. The government is just absorbing the geopolitical premium. That keeps application demand red hot in India, despite the astronomical raw material costs.
It's a wild contrast in economic strategy. While the U.S. and Brazilian farmers pull back, the Indian government ensures their domestic food security is completely uncompromised.
And despite China's export ban, they actually set record imports of certain nutrients in the first quarter to replenish their own strategic reserves.
Plus, in Southeast Asia, elevated palm oil prices are providing farmers with massive profit margins, so they're driving incredibly strong application rates. You have farmers looking at the exact same global crisis and making completely opposite agronomic decisions based entirely on the geopolitical priorities of their respective governments.
But whether an American farmer skips an application because of poor margins, or a Brazilian farmer skips it because of a credit freeze, the biological reality of farming remains completely rigid.
There is no chemical substitute for phosphorus.
Right, absolutely none. It is a fundamental, non-negotiable building block of plant life. It's essential for photosynthesis, energy transfer through ATP, root development. You cannot engineer a crop to simply grow without it.
So if a farmer in the US or Brazil looks at the price and says, not this year, I'll just plant without it, what actually happens in the dirt?
Well, in the immediate short term, the catastrophic effects might be muted. You can occasionally skip applying phosphate for a season by relying on the soil's existing reserves.
Management call that the biological bank account, I think.
Yes, agronomists refer to it as the biological bank account. If you've been aggressively depositing nutrients into the soil for the last decade, you have a positive balance. You can make a withdrawal this year to save cash.
But eventually, those checks start bouncing.
The soil bank account depletes rapidly, which raises an important question. What happens to the entire global food system when massive agricultural hubs like the US and Brazil actively underapply fertilizer for an entire planting cycle?
I mean, when those application rates drop too far, the actual metric tons of food produced per acre inevitably falls.
It has to.
And this is exactly why you, listening to this deep dive, need to care about these agronomic consequences. It isn't just an abstract problem for the agricultural sector.
Not at all. It impacts everyone.
Lower yields per acre mean less global grain and less global oilseed. When the total harvest shrinks, but the global population continues to expand, the stock-to-use ratios tighten dramatically.
And when those macro ratios get tight, food commodity prices spike.
Yes. The inflation you're going to feel at the grocery store next year is quite literally being baked into the soil right now due to these deferred applications.
It is a terrifyingly efficient chain reaction. The $1,200 sulfur spot price dictated by a naval conflict today becomes the $6 box of cereal next year.
It's wild to think about.
However, while the phosphate side of Mosaic's business is navigating this geopolitical roller coaster of margin squeezes and idled plants, their other major operating segment is quietly acting as the company's financial anchor.
Right. We absolutely can't ignore the potash side of the business. While phosphate is in absolute chaos, the potash market remains incredibly stable.
It's completely insulated from the recent turmoil in the Middle East.
Mosaic's Belle Plaine mine in Canada is just churning along, benefiting heavily from cheap North American natural gas. And their massive Esterhazy mine actually saw production volumes trend higher from the fourth quarter.
It is a deeply balanced, highly functional market. Campotex, which is a joint export arm they use to sell Canadian potash internationally, is fully committed through June.
Wow.
Yeah, and they are actually on pace to deliver a record year for international shipments in 2026.
I do want to clarify one nuanced data point for the listeners who might be modeling this stock out. Mosaic removed KMAG, which represents about 150,000 to 175,000 tons of product from their volume guidance.
Good catch.
Yeah, if you just glance at their North American shipments on paper, the volume looks artificially lower than historical trends. But the underlying demand for pure potash remains rock solid.
But even with potash providing this massive foundation of stable cash flow, Mosaic's overarching financial posture is deeply defensive.
Extremely defensive.
They are systematically building a financial fortress to ensure they can weather the storm on the phosphate side without damaging the company's long-term health.
Let's run through the defensive playbook management outlined, because it is aggressive. First, they are heavily slashing capital expenditures.
Yep, the CapEx cuts were significant.
They cut their 2026 CapEx guidance from $1.5 billion down to $1.25 billion. That is $250 million in cash preserved simply by delaying internal projects that aren't immediately critical to operations.
They are also restructuring their internal costs. They initiated a targeted workforce reduction in their corporate support functions that is expected to save $50 million annualized.
And that compounds the benefits of a prior $100 million value capture program they executed last year, right?
Exactly. And they are ruthlessly optimizing their physical asset footprint. They finalized the sale of their Carlsbad potash mine in New Mexico, moving away from higher-cost assets.
But the massive move was in Brazil. They completely idled the Araxá and Patrocinio facilities.
The Brazilian asset optimization is incredibly telling regarding their discipline. They took a massive $442 million charge associated with idling those specific facilities.
$442 million.
Yeah, with $328 million of that being a non-profitable, non-cash charge hitting the books.
I have to ask, why take such a massive, ugly hit on the earnings report right now? It just looks so bad on paper.
Because the asset was a structural loser that was quietly bleeding cash. Those specific facilities were exclusively focused on producing SSP, or single superphosphate.
Okay, so it's a specific product issue.
Yes. Management was highly transparent that while the current sulfur crisis definitely accelerated the decision, those plants hadn't been meeting their internal hurdle rates for a long time.
I see.
The Brazilian market has been flooded with incredibly cheap SSP imports, and Mosaic's domestic production simply couldn't compete on cost. Instead of engaging in a slow bleed to protect their ego, they just ripped the bandage off.
And by idling the plants, they immediately saved $20 to $30 million in annual maintenance capex.
It is a masterclass in dispassionate capital reallocation.
It really is. But the most revealing financial maneuver they discussed revolved around the concept of working capital. The CFO brought up the internal math of their sulfur inventory, and the scale of the cash required to run this business is just staggering.
It highlights the sheer gravity of commodity price swings on a corporate balance sheet. Luciano detailed that Mosaic generally holds about 800,000 tons of sulfur in inventory at any given time to ensure their facilities can run smoothly.
That is a lot of sulfur.
It is. Roughly 400,000 tons of that is raw, liquid sulfur sitting in massive heated tanks, and another 400,000 tons is the sulfur equivalent baked into the finished fertilizer, sitting in their warehouses waiting to be shipped.
Okay, let's do the math on 800,000 tons.
Sure.
Every single time, the global price of sulfur jumps by $300. Well, wait, that is almost $250 million, $240 million to be exact, of Mosaic's cash that is suddenly tied up in working capital.
Exactly right. It evaporates from their liquid balance sheet and gets locked into the physical inventory sitting in the tanks.
It is a massive liquidity headwind.
It is, but if you analyze management's tone throughout the call, there was absolutely no panic. They are countering this headwind with extreme operational agility.
Right, because they sold 1.9 million tons of phosphate in the first quarter, which was actually more than they produced. They successfully released $120 million of working capital from those finished goods back onto the balance sheet.
And because they are making the hard choice to temporarily curtail production now at Bartow in Louisiana, they expect to release even more working capital in the coming quarters.
They are actively targeting between $300 million and $500 million in working capital release for the year. By monetizing that inventory, slashing capex, and reducing headcount, they are intentionally hoarding cash.
They are ensuring they have the absolute liquidity required to simply wait out the supply chain storm, regardless of how long the geopolitical conflicts take to resolve.
It is the definition of corporate resilience. You manage the immediate existential crisis through defensive financial engineering, but you do not sacrifice your future.
Because while the bulk of the call focused on raw material costs and idle plants, hidden at the very end of the presentation were two massive, highly disruptive bets Mosaic is making on the future of the company.
And these are investments that could redefine them entirely, pulling them out of the traditional 20th century fertilizer extraction business and anchoring them directly into the 21st century high-tech economy.
It's a huge pivot.
Let's look at the biology side first. Mosaic Biosciences. Despite all the macroeconomic headwinds we just discussed, farmers pinching pennies, delaying purchases, struggling with massive credit crunches, the agricultural sector is aggressively buying biological crop products.
It's true. Mosaic expects to launch 8 to 10 entirely new biological products in 2026 alone, and they project the revenues for this segment will double again this year.
Double. That's incredible growth in this environment.
It is a testament to the fact that if a company can offer a product that delivers a highly visible, undeniable return on investment through increased yield or improved fertilizer efficiency, farmers will locate the capital to buy it. even in a deeply depressed market.
Biologicals really represent the next massive frontier of crop enhancement.
We are moving beyond just dumping base chemistry onto a field and moving into the highly targeted optimization of the microscopic living ecosystem of the soil itself.
Okay, but here's where it gets really interesting, and I mean, genuinely mind-blowing from a global macro perspective. Let's talk about rare earth elements.
This was the standout moment of the call for me.
Mosaic announced a formal project development agreement with a company called Rainbow Rare Earths in Brazil, specifically targeting their Uberaba gypstack. And management noted they are evaluating similar extraction opportunities in the U.S.
This represents a fundamental paradigm shift in critical mineral extraction. For decades, traditional hard rock mining for rare earth elements, metals like neodymium and praseodymium, which are essential for creating the permanent magnets used in modern technology, has been incredibly environmentally destructive.
And vastly expensive to permit, right?
Yes, and almost completely dominated by foreign monopolies. China controls the overwhelming majority of the global rare earth processing capacity.
You literally cannot build a modern society without these elements. You cannot build an electric vehicle battery, a smartphone, a wind turbine, or advanced defense systems without rare earths.
And where is Mosaic going to find them? Buried in their own garbage.
Exactly. We really need to break down the brilliance of this phosphogypsum strategy.
To understand the opportunity, you have to understand the waste. When you take raw apatite rock, phosphate rock, and bathe it in sulfuric acid to create the phosphoric acid needed for fertilizer, you create a massive amount of a byproduct called phosphogypsum.
Which is essentially calcium sulfate.
Right. And for the entire history of the industry, this has been considered highly problematic industrial waste. It contains trace amounts of naturally occurring uranium and radium from the source rock, making it mildly radioactive.
And because it's so difficult to deal with, it is pumped into these massive, highly controversial engineered mountains called gypstacks. They are a massive environmental liability that fertilizer companies are legally obligated to monitor and manage forever.
But those trace minerals in the rock don't just include uranium. They include highly valuable rare earth elements.
And that's where Rainbow Rare Earths comes in.
Exactly. They've developed proprietary solvent extraction technology that can pull those specific high-value rare earths directly from this existing phosphogypsum waste.
So they aren't going through the decade-long, multi-billion-dollar process of permitting and digging a new hard rock mine.
Not at all. They are simply processing the byproduct that the fertilizer industry has already mined, crushed, and conveniently piled up for them over the last 50 years.
It is the ultimate corporate alchemy. They are quite literally engineering a process to turn mildly radioactive fertilizer waste into the critical components required for smartphone processors and EV engines.
It's brilliant.
We are talking about taking one of the company's most heavily scrutinized environmental and financial liabilities, the perpetual management of these massive waste stacks, and flipping it into a highly lucrative, critical domestic supply chain asset for high-tech manufacturing.
The dual benefit is almost unprecedented. From an environmental remediation perspective, you are actively drawing down and processing a legacy waste site.
Right.
And from a national security and economic perspective, you are creating a massive domestic source for critical minerals that are currently subject to immense geopolitical blackmail and supply chain risk.
It perfectly aligns with the massive wave of government and private capital currently pushing to secure critical mineral supply chains outside of traditional monopolistic choke points.
So if you are someone who tracks the green energy transition, the geopolitical race for electric vehicle dominance, or even national defense security, you need to be paying close attention to this.
This legacy agricultural company, traditionally known for digging dirt out of Florida and Canada to help farmers grow corn, might unexpectedly become one of the most critical players in the global tech supply chain.
It perfectly illustrates how massive industrial companies must evolve to survive. You have to aggressively manage the immediate existential crises like the $1,200 sulfur spikes and the Middle East shipping disruptions with disciplined, defensive financial maneuvers.
But simultaneously, you have to allocate capital and vision to the long-term, highly disruptive innovations that will define the next century of your business. It really is a masterful balancing act between extreme defense and futuristic offense. And that brings us to the end of our deep dive into Mosaic's Q1 results. Let's summarize the incredible, completely interconnected web we've explored today.
It's quite the web.
We started with a geopolitical conflict, thousands of miles away in a specific shipping strait in the Middle East. That naval conflict traps commercial oil tankers, which artificially restricts the global supply of sulfur, a mere byproduct of refining that oil, sending its spot price to astronomical levels.
Which then forces a corporate boardroom in Florida to look at their stripping margins, realize the math is broken, and make the painful, highly disciplined decision to idle a massive multi-million-ton chemical plant in Louisiana.
Which means millions of tons of essential fertilizer suddenly vanish from the global market. That massive supply shortage, combined with severe domestic credit issues, causes a farmer in Brazil to make the hard choice to skip applying vital nutrients to their soil this planting season.
Which rapidly depletes the soil's biological bank account, leading directly to lower crop yields next harvest, which severely tightens the global stock-to-use ratio for essential grains.
And that ultimately is what causes the price of the bread, the coffee, and the meat you buy at your local grocery store to spike. The invisible machine at work.
It is a stark reminder that we do not live in isolated regional economies. We live in a single, deeply intertwined global ecosystem, where a ripple in the Persian Gulf inevitably becomes a tidal wave in the American supermarket.
But before we go, we want to leave you with a final provocative thought to mull over, building directly on that amazing rare earth element revelation we just discussed. For over a century of rapid industrialization, we have viewed industrial byproducts purely as environmental hazards, toxic liabilities to be managed, regulated, capped, and hidden away from the public in massive stacks or buried deep underground.
We have treated them as the unfortunate, permanent cost of doing business.
But what if the vital resources required for the next century of our technological advancement don't need to be violently extracted from pristine rainforests or deep-sea vents? What if the critical minerals we are desperate for are already mined, sitting right here in plain sight, in our own backyards, simply mislabeled as waste? If a traditional 20th century agriculture company can find the future of the high-tech economy buried inside a pile of controversial fertilizer byproduct, what other invisible gold mines are we currently walking past every single day? Next time you look at a simple tomato in the grocery store, I guarantee you'll see the entire complex world hidden inside it.